Hey everybody, welcome back to Dividend Stockpile. Today I'm joined by David Auerbach, Chief Investment Officer at Hoya Capital, one of the leading authorities in the real estate and REIT investing space. With market shifting, interest rates changing, and real estate fundamentals evolving across sectors, there's no one better I wanted to talk to than David when it comes to the REIT investing and the current state of REIT markets. So David spent his career dissecting the dynamics of real estate, capital markets, and income-focused investing. Today, he'll help us break down the opportunities, risks, and trends shaping the REIT space. So, David, welcome to the channel.
Jeremy, thanks for having me. That was a great intro. I appreciate that.
I appreciate you coming on. Really excited about our conversation today. I follow your work both on Seeking Alpha and your email newsletter. You guys are the experts when it comes to REIT investing, so I really appreciate you taking the time to come on. So just quickly, for those people who don't or aren't familiar with you, can you give a little bit of background on yourself and Hoya Capital?
I've been in the REIT industry for over 25 years. I started as an institutional trader here in Dallas at a firm that's now known as Green Street, but back then it was Green Street Advisors. I started in March of 2000, the day that the NASDAQ crashed, and goodbye tech bubble. And I was at Green Street for about a dozen years, and really I got to watch the REIT industry grow up, watching many companies come to market, a wealth of new investors, new sectors, an industry that basically evolved from the 80s sector to what we're dealing with now many years later today. And getting involved in the REITs was just by luck, by chance. I responded to a classified ad in the local newspaper for, it said 2-inch font, got Series 763, call this number. And I was a year out of college basically at that point, and I went in for the interview. And I remember my boss, when she hired me, she's like, kids your age don't get the opportunity that you're about to be given. And I'm like, oh, come on, what are you talking about? Well, here we are many years later, and I can look back and she's like, yeah, I see where she was coming from, because REITs are a very unique industry in Dallas, Texas, of all places. So it's been quite a roller coaster. And if the first 25 years are any indication, I can't wait to see what's ahead for the next 25.
Yeah, I think to that point, the REIT industry has expanded so much from what it was at the beginning. It really came around as a way for the government to incentivize people to invest in real estate and give it access to the capital markets when it comes to real estate. But now there's so many different sectors within the REIT space. There's so many different opportunities, whether you're looking for high dividend growth, high current yield, a little bit of both. There's so many opportunities in so many different sectors. I mean, we'll talk about some of the sectors later, but you have everything from cell phone towers to data centers to commercial office buildings to residential. Like, there's so many things you can do in the REIT space. So that's why I really wanted to have you on to talk about the current state of the REIT market, what's working, what's not working, what some opportunities are coming up. So I'm really looking forward to that. So I guess with all that, high level, what would you say is the current state of the REIT market? Where are we at right now?
You're at a point in time where the sector has probably been about as unloved in the period of history. REITs have underperformed the S&P by about 70% going back to the Fed rate hiking cycle that started in March of 2022. We're in an environment where the 10-year Treasury remains elevated. We see negative headlines, frankly, that come at us every single day, whether it's political, inflation, tariffs, the list goes on and on. But I think what gets misunderstood is how many of these companies have long-term leases in place that, frankly, weather the day-to-day headlines that we see. And so where we stand, I think, is at a very pivotal point in time, because we're about to see some major changes. Not only is the calendar changing very soon to 2026, but we're about to see a new evolution of the Federal Reserve, where we're about to see, to be polite, a more dovish chairperson sitting in that seat that wants to see interest rates continue to be cut.
Yep.
We were always taught that REITs are interest rate sensitive, and we can get into that. But I disagree with that notion.
Okay.
And when REITs are considered interest rate sensitive, thus any cuts in interest rates should provide tailwinds to the REIT sector. So we're at that point in time where it's like you don't want to miss the ship before it's left the port. And I mean, I've been saying this for a couple of years now, and obviously it hasn't worked quite out because of the way the markets move, blah, blah, blah. But you want to own REITs before the Fed cuts rates. You don't want the Fed to cut rates like, oh, now's the time to go out and buy REITs, because then that ship has already sailed.
Yeah.
So I think now it's important to understand the fundamentals of REITs, the importance of the dividend stream of REITs, and why day-to-day market moves don't matter when it comes to that income side of your portfolio. We'll get into that.
Yeah. That's awesome. Yeah, so I 100% agree with what you're saying. It's been really tough over the last couple of years being a REIT investor, because the market has a different mindset right now. It's all about growth. It's all about the high beta names. Things that are going to the moon, as they say, and then add on crypto on top of that. There's so many distractions for investors right now, and so many new products. We're talking offline about all the new ETFs that are coming out there. There's so many things for people to pick from. And when you look at a REIT that might be paying 4 or 5% compared to some of these other ETFs that are shooting at 50%, some people get discouraged holding on to REITs. But there's a lot more to REITs than just the current yield. It's that stability. It's that growth over time. There's so much more to it.
That ETF that's paying out that distribution that you're talking about, I mean, holy cow, look at the data. Pull up a price chart on one of those ETFs. I mean, it's like going to Six Flags.
Yeah.
So when you think about REITs, it's the complete other end of the spectrum. REITs move really like in a narrow band.
Mm-hmm.
I always say when you buy REITs, you're not buying the REIT for the stock price appreciation. You buy the REIT for the dividend income stream. Look at a company like Realty Income, the letter O. Their nickname is the monthly dividend company. That's what they've done for years and years and years. I don't have a picture of the chart of what the stock has done. But if you look at the chart of what the dividends have done over the course of time, and if you're in the situation that you can reinvest those dividends, like you started out here 20 years ago, and here's where you're at today just because of all the dividends that you've earned off of this company. Any stock price appreciation is basically just the cherry on top of the sundae. That's the extra gift that they're giving you. But what you should care about is my dividend protected? Is my dividend covered? Is my dividend safe?
Absolutely. And we're definitely going to dig into dividend safety later and what some of the criteria you look for when it comes to that. But yeah, absolutely. You're in it for the dividend. You're in it for the dividend growth. And to your point, the reinvesting a dividend just skyrockets that whole process, that 10, 15, 20 years later, when you actually do need the money, your income stream from those dividends is massive. You can live off that and not worry about the capital appreciation, not worry about selling off shares. That's really the whole point. So when we first started the conversation, we talked about all the different sectors that the REIT space involves at this point. So what would you say some of the sectors are out there that maybe surprised you this year, either in a good or a bad way?
Well, I think we should take a step back and realize how many sectors that are out there. You only listed a couple of them. And I think really at the end of the day, there's over 20 subsectors that are out there. And it could really be more if you break out sectors like healthcare or residential, that list does grow. I think the one thing to realize is how instrumental REITs are to our day-to-day lives. I'm willing to bet chances are, no matter who is listening to this or watching this podcast, has interacted with a REIT today or is going to interact with the REIT. How? Well, I'm going to give you the easiest example right now. You and I are using a REIT to have this conversation.
Yep.
You are using a REIT to watch this video later today, tomorrow, next week, next month, next year. That's being facilitated by a REIT. You got one of these things in your pocket, a thing called a cell phone. Guess what? Every single time you use a cell phone, chances are you're using a REIT.
Yep.
REITs are the core fabric of our day-to-day lives. We don't think about it, but we use it. And that's why I go back to that, our REITs interest rate sensitive, because the end user of the properties in a given day, that cell tower, that data center, whatever it is, did you wake up that morning and say to yourself, gosh, where are interest rates at today? What's the 10-year treasury doing? Oh, wow, interest rates are up. I can't use my cell phone. Come on. That's baloney.
Yeah.
So that's number one. What stood out this year? I mean, this is the year of AI.
Mm-hmm.
Let's be honest. Every single REIT in some form or fashion is trying to embrace AI, whether it's on the data center industrial side of it, building out the warehouse or the data center to facilitate, or implementing AI to improve operations, help to lower your expenses, which indirectly grows net income at the end of the day.
Mm-hmm.
AI has been the sector that has obviously stood out this year. I think other sectors we look at is like senior housing.
Mm-hmm.
Senior housing has done a full round trip from being very unloved because of what happened during COVID to now massively in love. And it's a multi-layered reason. But number one is frankly lack of new supply. And
Mm-hmm.
so when you talk about lack of new supply with a growing user base, because I don't mean to be rude, but we're, 15 minutes older than when we started this conversation, this is a sector that's going to continue to be in demand. I think
Yeah.
another sector that's really stood out is retail. We've
Mm-hmm.
heard all about the headlines with tariffs and inflation and all that stuff. And yeah, I think there's this tale of two stories. There's the upper end, there's the lower end that are going through their dynamics. But what you don't understand when you peel back the layers of that onion is to realize we really haven't had much new retail development over the past several years. So that existing landlord space that they own becomes that much more valuable every single day. And these are companies, landlords that are seeing, frankly, double digit rent increases because of demand for high quality, well located shopping centers. So I think that off the bat are a couple of sectors that have really stood out this year.
So thank you for talking about some of the sectors that you feel have surprised you a little bit. But what are your thoughts on the real estate sector? So you have apartments, you have mobile homes, you have things like that, apartments, single family residence. How do you feel on that's going? Because I know like a lot of people are saying that real estate is dead right now. No one's buying, no one's selling, things like that. So how do you feel about the REITs in that sector right now?
Well, housing and residential is a very important focus for us at Hoya. We have an exchange traded fund, the Hoya Housing 100 ETF, the ticker is HOMZ, HOMZ, where we focus on this every single day.
Mm,
And this is the one sector that we think is frankly the most imbalanced because there's a huge demand for housing, but there's not enough affordable product out there to satisfy the demand,
yeah.
layered with elevated mortgage rates, make those houses unaffordable for the average consumer. So as a result, it's the residential REITs, such as apartments, single family rentals, manufactured housing, that benefits from that demand. By the way, talking about sector evolutions, single family rental is a great example of one of those sectors that came into its own from distress.
Mm-hmm.
Go back, gosh, 15 years ish ago now,
Mm-hmm.
back when we had the housing crisis, when many homes were foreclosed upon in Florida and Georgia and some of these places, Blackstone was walking into bank branches saying to them, how many foreclosed homes do you have on the books at this bank location? We've got 25 homes valued at 25 billion. We'll buy those 25 homes right now for 17 million.
Yep.
Deal.
Yep.
And that's how Invitation Homes was born. Was literally just buying swaths of distressed housing, portfolios of distressed housing. With distress and volatility comes opportunity. So I think it's just very interesting because that's how that sector was born. Until your favorite home builder starts delivering a more affordable product,
Mm-hmm.
or until we see a reset in mortgage rates, we still have a long way to go. And
Yeah.
by the way, a 50-year mortgage is not the answer. A
Totally agree.
portable mortgage is not the answer. It's building enough affordable housing for the demand that's out there to then eat into some of this gap. Because we're talking what I see different numbers every week: 4 million, 5 million, 6. multiple millions of homes need to be developed to tap into this supply-demand imbalance.
So another thing that a lot of REIT investors are concerned about, or it's in the news or financial media at least, is a lot of the REITs have taken out mortgages when it was really low, like right after COVID, things like that. But they're coming up to this what they call refinancing wall, where those initial loans are going to be reset. With the yields being or the rates being so much higher right now in the market, what's going to happen when all those loans have to be reset or redone?
I get this question all the time. The doom headline, the commercial real estate wall of debt that's coming due, the wall of debt. Great. Love this question.
Okay.
Number one, REITs only make up a very tiny fraction of the world of commercial real estate. So I think it's very important to realize that there's many different sectors of commercial real estate. I like to say, and I've said in several other interviews, the REIT industry is like your graduating class in high school. You have the top 10%, the valedictorian, the salutatorian, the REITs in the S&P 500, the dividend champions. You had the bottom 10%, the bullies, the troublemakers, the kids in detention, the REITs that cut their dividends, the REITs that are over-levered. You have the middle part of the curve, the students that go under the radar, that don't cause the problems, that are the small and mid-cap REITs or the underfollowed, underappreciated names. And that's what we focus on at Hoya, is we think that that's where the opportunity lies. So why do I point on this? If you look at it at the REIT level, most of these REITs do not have a wall of debt that's coming due. They're laddered out for 5, 10 years type stuff. Now, fair and balanced, blah, blah, blah. You are right. There are some REITs that are over-levered or do have debt that's coming due. But here's a couple of things to think about. If you are credit rated by a Moody's, a Fitch, an S&P, you know every single day what that number is. I want to borrow 5-year paper at X. I want to borrow 7-year paper at Y. I want to borrow 10-year paper at Z. You know what the market is every single day, period. So you would know then what your incremental interest expense is going to be. Now, it doesn't matter if you're a publicly traded REIT or you're Blackstone, the REIT that isn't a REIT, that basically is the 800-pound gorilla of commercial real estate, who also has debt coming due on properties and all that stuff, right? The problem I think that a lot of folks have was they look at REITs with COVID glasses still, because it was free money back then when interest rates were at 0. And these guys could borrow for nothing, right? So here we are, fast forward many years later, those notes maturing, got to refinance. Okay. At the end of the day, for a S&P 500, AAA, AA rated name type of stuff, the incremental interest expense is not going to put you out of business. The small cap, micro cap REIT that's over levered, that has stuff coming due, is going to face some of those hurdles. And we are seeing that as an example, OPI, Office Properties Income Trust, which basically has defaulted on their notes and is BK right now. Or again, some of these other underloved micro cap names. But you're talking about a 1%, 2% versus the other 98% of the names out there that don't have this wall of debt that's coming due. Case in point, you've got both American Tower and Prologis doing notes issues today, actually, that are going to be pricing after the close. As I tell folks, the lending window, if you want to borrow money as a REIT, it is wide open. You can, and REITs have raised tens of billions of dollars, if not more, in new debt this year. The other thing to think about is that who's the partners? It's the biggest banks on Wall Street that
Hmm.
are, helping facilitate these deals. It's not operated by some third, fourth, fifth tier investment bank. It's the biggest boys on Wall Street that are working with these companies. So that tells you that thaw and sentiment is improving because, again, the lending window is wide open and these guys are able to raise 500, $700 million in less than a day.
Yeah. That's actually very reassuring, and it makes a lot of sense. So I appreciate you talking through that. So for those companies who might be in distress or might have the difficulty raising funds, do you see a lot of mergers and acquisitions coming up in the near future? Or
Absolutely.
okay.
Absolutely. So we have seen, going back to that March 2022 timeline, we've seen 36 different REITs either merge, go private, something like that, or find some way to explore options. And in
Okay.
the past quarter alone, we've seen 10 different REITs go down that road,
Mm.
exploring options, going through a merger. A couple of REITs issued preferred stocks. We hadn't seen preferred stock issuance in REIT land in years. So the industry is ripe for consolidation. Do we need to have 13 apartment REITs as an example, whatever the number is these days,
Hmm. Hmm.
or that many industrial REITs? Like there are some, or retail strip center REITs. There are some sectors that are definitely going to see some consolidation, but think about companies that have been around for so many years, like a Kimco or Realty Income, as I mentioned before. Man, it's business as usual. You know what I
Yeah.
mean? Like, how many cycles have these guys been through? How
Hmm.
many ups and downs and, historic events, you want to call it, that they've been through? That for a lot of these management teams, it's blinders on. My
Hmm.
job is to focus on leasing out my space, maximizing my rent growth, pushing out as much of that to my shareholders and dividend income that I possibly can. That's what all these guys focus on 24/7.
Yeah, makes sense. It'll be interesting to see, how that trend continues over time to see which names do make it and which names don't. But I'm sure that like the top tier ones are going to be the ones doing these acquisitions and taking advantage of this distress, as you called it earlier. So
And you could always assume that Blackstone is going to be in the mix as well, whether they're selling off their assets or they're buying out some of these REITs. You could always assume that they're probably going to be at the table too for that conversation.
gotcha. So we talked about some of the sectors that you feel like are going to do really well. What are some that are maybe at risk of dividend cuts or um, dividend traps, if you will? Is there any certain sectors that people might want to look out for?
But one company that's been very transparent in their outlook is Alexandria,
Hmm.
ARE. They focus on lab space, life science. Um, because of let's call it a challenging time that doesn't have the shine like it did during COVID, for a
Hmm.
company that's overdeveloped and has lofty expectations, they're forecasting a dividend cut next year.
Okay.
Their investor day, I believe, is next week, later this week. Where that may come out when they establish their 26 guidance, and they're guiding towards a softer year next year. So that's
Yeah.
one company.
Okay.
Another sector that's been under pressure is like cold storage. So
Mm.
like the Lineages, Americolds of the world,
Yep.
those are, I'm not saying that their dividends are necessarily at risk, but they've been under a lot of pressure, where it's kind of like a put up or shut up because they've been under the knife.
Okay.
Um, I think some of the other office REITs, like a Brandywine, a Hudson Pacific, a Piedmont, some of these underloved names that have been going through the ringer, that might be out there. But, again, it's hard to, because you had a company like Boston Properties, BXP, that cut their dividend this year.
Hmm.
And BXP is on that left side top 10% part of the curve that we always talk about, but they cut their dividend, even though they were kind of projecting it. When you see quality names do cut, it does kind of send a chill because wait, we rely on you guys.
Yeah.
We're out there talking about you and how great of a company you are and how great this story is, but yet you cut earnings. You cut your dividend. Like that sucks. So I think one thing to note though, I mentioned this comparison versus COVID, and the reason why was when COVID hit, REITs were like at an all-time high. The market was peaking. Fundamentals were rocking for all these companies. They were at a great spot. COVID hits, boom, they go into the tank.
Yep.
But fast forward, fundamental-wise, current REITs today are blowing away what they were doing at COVID. I mean, blowing away the numbers that they were putting up. But the dividends have not caught up to where they were pre-COVID yet. And the management teams got asked that question all the time.
Mm-hmm.
Why aren't you growing your dividend where you were pre-COVID? Why aren't you aggressively growing your dividend? And I give management teams credit for this because they're being good financial stewards of their capital.
Yeah.
We can push that out to you. But that means that we forego this opportunity to develop, acquire, merge, whatever it is.
Mm-hmm.
We'd rather have it for a rainy day to protect versus to overpay. And if we have a miss, then have to come back to you and say, we got to cut your dividend.
Yeah.
So a lot of these REITs will tell you, we're 80%, 80%, 85%. We have the ability to grow, but we're choosing to be cautious with our capital. And I respect that.
Mm-hmm. With everything going on in the economy, between the tariffs, interest rates, things like that, it makes sense to be cautious and to be opportunistic, going forward. So it definitely makes sense that they might be a little bit more hesitant to hand out all the dividends or distributions at this point. So you talked about a lot of the things that could go wrong, but what are some of the things you look for to show that a company is doing it right? Is there a certain amount of growth you see looking at? Is there payout ratios you look for? What constitutes like a good REIT for you right now?
I think it's all of those things, but I usually take a more 10,000-foot approach when talking to the everyday investor about this.
Okay.
The everyday investor doesn't care about price to FFO multiples and a lot of the nuances that go into REIT accounting.
Mm-hmm.
And I basically take it with this approach. Don't answer this question, just think in the back of your head. Pick your favorite stock on Wall Street, not a REIT.
Mm-hmm.
Apple, Nvidia, Microsoft, whatever. Pick your favorite stock. You as the investor want that company to do 4 things at the end of the day. Only 4 things, literally. Grow revenues, grow profits, grow dividends, and grow your annual guidance, your earnings per share, your FFO.
Mm-hmm.
If a company can do those 4 things, regardless of all the macro headlines and stuff that's being bombarded at them, you would think the company is on pretty solid footing. And that's what's happening in the REIT industry. Most of the REITs, by and large, are doing those 4 things every single day or quarter.
Mm-hmm.
And yet it's not reflected in the stock price. I remember talking to a REIT CEO a couple of months ago at a conference. It was right around Liberation Day with the tariffs back in April.
Yeah.
And I'm like, how's it going? And he's like, David, I got to tell you a story. Okay, this is great. So if you take Liberation Day -1, Liberation Day +1. So T -1, T +1.
Yep.
So over the course of these 3 days, our dividend hasn't changed. Our earnings haven't changed. We've actually signed leases over these past couple of days. But my stock price is down 30%. What does that investor know that I don't know when I'm sitting behind this desk running this company every single day?
Mm-hmm.
And I think what the important thing here to realize is it goes back to those blinders that tariffs, the landlords don't know what tariffs are going to be. They have no idea. Their job as a landlord is to lease the space, fill up the building. It's the tenant that might be exposed to tariffs and stuff, right?
Mm-hmm.
But if they're still signing leases at the Empire State Building or pick your favorite office building in a certain market, then what's the impact of tariffs?
Yeah.
Obviously, go talk to your tenants that are exposed to that, or the shopping center, the grocery store. Kroger or Albertsons, we'll just pick that on them because of the largest grocery stores in the country.
Mm-hmm.
They're coast to coast. How many shopping centers that REITs own are Kroger and Albertsons in? And the answer is obviously a lot, right?
Yeah.
they're paying the rent.
Mm-hmm.
The consumer who's going to buy that product at the grocery store may be subject to higher prices because of the tariff, but the rent's getting paid. And I think that's what kind of goes back to this message that we're trying to communicate here. REITs are boring, all right?
Mm-hmm.
But boring is good. And why do I say that? We talk about all these macro headlines that are being thrown at every single day. How many times do you see the price of Bitcoin show up on your favorite business news network? And it's
Mm-hmm.
all the time, right? Because what is Bitcoin doing right now? It's a roller coaster.
Yep.
If you want to buy that 1 day trade, that roller coaster, go out and buy yourself a hotel REIT. Go out and buy stock in a hotel REIT because those are 1 night contracts.
Yep. True.
But if you throw out hotels, an apartment, a 1 year lease, an office shopping center, a 5 to 10 year lease,
Yep.
up to a company like Safehold that owns ground leases that could have a 99-year lease maturity.
Mm-hmm.
What I'm trying to say here is that the underlying leases that these REITs have signed with their tenants have long durations with set rent bump increases every single year. So that landlord knows the rent is going to go from X to X times up 1.05%, up 5%, the next year up 5%, the next year, the next. Okay. They know what that income stream looks like. But because of the stock volatility in the market, it's being discounted by the actual fundamentals. So when you have a company like Tanger, which does outlet malls across the country, tell you that our rental rate, our rent increases are up double digit year over year. We've signed all these new tenants to at market leases.
Mm-hmm.
We're buying the most attractive properties in desirable markets, but it's not being reflected in the stock price. That's the opportunity.
Yep.
Okay. Because again, that lease that Tanger has in place with the Coach outlet store for 5 years with a 5% rent escalator, do that times 10 or 20. Guess what? Your dividend is going up next year and the following year and the following year. But people, because they focus on stock first, it's, well, yeah, but look, Tesla did this. Or this stock that Jim Cramer was talking about has done this, or whatever it is. And that's what I said. With REITs, it's like this. It's a very slow and steady up or down. That's what you look for. Again, REITs are the ballast that keeps your ship afloat. It lets you play the Bitcoin ETF, the prediction market stuff that's out there these days, the more riskier stuff. When you think about REITs, you don't think about it from risk, you think about it from income.
Mm-hmm.
Where's the income? The dividend. That's what you should focus on. So, as an investor, what should you care about? What does the dividend look like? Show me a chart of the dividend growth over the past 5, 10, 20 years of how long it's been public. If the chart looks like this over the long course of time, probably something to look at. If the chart looks like this, very steady, it's not a bad thing. That slow and steady wins the race. Your dividend just isn't growing. But if it's something like this, again, not this, but something like this. So 1, 2, 3, 4, 5, 6. That 1 cent dividend now becomes 20 cents 10 years from now. That slow and steady wins the race is why you should be investing in REITs. There's a lot of research that's out there from like Morningstar and some of these other places that talk about portfolios that own REITs versus didn't own REITs. And oh, by the way, when did you own the REIT? Did you own it later in time or did you own it on the day your child was born? The right timing is the difference between having, frankly, 7 figures in your account and 6 figures in your account. And it's all because of the power of the dividend income stream that these REITs pay out. Remember, a REIT is just a tax structure. And when you boil it down, at the end of the day, the code is 95% or more of that taxable net income is passed through to you, the shareholder, as a form of a dividend. Period. So why does that matter? Who's the biggest shareholder of those REITs? besides your BlackRocks, Vanguards, and ETF issuers. I'll give you a hint. It's the guys in the C-suite that run the company. So when you're Mr. or Mrs. CEO and you own 10 million shares of, we'll just say, Empire State Realty Trust, and Empire State raises their quarterly dividend by a penny, what's 10 million times a penny? A nice quarterly bonus for that executive is what that is.
Yeah.
They are as entrenched on the front line with shareholders than any other sector that's out there. Why? All because of the dividend.
I love it. Thank you so much for that state of the REIT world right now. I think you came with a lot of great points and a lot of things for people to really think about, sticking with REITs and understanding why REITs are so powerful in your portfolio. So really appreciate you going through all those details. Before we end, I know that Hoya Capital offers a lot of resources to retail investors when it comes to REITs. Can you talk briefly about some of the things you offer, your ETFs as well as your research?
Thank you for that. Yeah, so Hoya Capital is a REIT research provider. That's our home. Our home base basically is Seeking Alpha, although you could find our research on several other channels. We have a very large YouTube presence, social media presence. We've launched REITTV.com, REITTV.com. It's basically all the REIT educational videos that are out there from NAREIT, CNBC, Bloomberg, Cohen and Steers, all the great reputable REIT sources that are out there sharing REIT education with viewers. In addition, we do have 2 exchange-traded funds that are listed on the New York Stock Exchange. I did mention Homes, the Hoya Housing ETF earlier. That's 100 stocks that make up the world of residential. Home builders, residential rentals, apartments, single-family rentals. But then it's also the home goods and furnishing side of the equation, the retailers, as well as the service providers, the brokers, the Zillows, the Redfins, all the folks that make up the entire housing industry is in one wrapper. But our growing fund is the high dividend yield ETF. The ticker is RIET. We picked the REITs, and we it's a rules driven fund, so we cap sector weightings. We have different allocations for large, small, mid caps, but we try to find the REITs that pay the highest dividends with the lowest leverage ratios. We pay a monthly dividend. We do have, in addition, it's currently the only REIT ETF that I know that combines both common and liquid REIT preferred stocks. Nice. So 1/3 of the names, or 10% of the portfolio, is in REIT preferreds. Right now, we're paying a monthly dividend that's annualized around 11%.
That's a really good yield. And that will benefit a lot of people who are looking for that higher yield to current income. But you still have the diversification and the rules put in place to make it a stable product over time. So thank you for sharing some of the information about Hoya, things that you guys have to offer. Everyone definitely go check out those ETFs. I'll pop them up on the screen again here for everyone. Obviously, you go look to make sure it fits what you want, but definitely take a look and see what they offer and see how it can fit into your portfolio. So David, I really appreciate all your time and information about the state of the REIT industry, about what your company can offer. I really appreciate it, and hopefully we'll be able to talk again real soon.
Thanks so much for having me. Thank you.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.